Let me ask you a question. Would you rather earn money while you sleep, or you could owe more money the longer you wait? That's interest. It's either working for you or against you. And if you don't understand it, it can quietly drain your wallet, or it could silently build your wealth. Interest touches everything. It touches your savings, it touches your debt, your investments, your credit cards, even your mortgage. So if you don't know how interest works, you're basically kind of walking through the financial world blindfolded. Today, we're diving deep into how interest works, the difference between simple interest and compound interest, where to find them, where to avoid them, and most importantly, how to start earning compound interest for yourself. We're even throwing in a history lesson that'll give you more context than your high school economics class and Mr. Johnson ever did. So what's interest? In its simplest form, it's the cost for borrowing money, or it's the reward for lending money. So let's break this down. If you take a loan, say from a bank or a credit card, you're being charged interest. That is the price you're paying for using someone else's money. But if you lend money, whether through a savings account, a bond, a policy, a contract with a neighbor, you earn interest, and that's your reward for being the lender. So let's define the two really key types. You've got simple and you've got compound. Simple interest is precisely what it sounds like. It is interest that is calculated on the original amount or the principal only. So here's what I mean. If you borrow $1,000, we'll use a nice round number. At 5% simple interest annually, you'll pay $50 each year. That's 5% of 1,000. It does not matter the loan term. Now, compound interest, on the other hand, is an absolute game changer. It is complicated, calculated, and this is where a lot of the institutions will really start to get you. Compound interest is not calculated just on the principal. It's calculated on accumulated interest as well. So essentially, you can sometimes be paying interest on your interest. Or again, if you're the lender, earning interest on your interest. So here's where it can get powerful. Compound interest, it means that time has become your best friend. Or if you're the borrower, time has become your worst enemy. If you've got $10,000 in a savings account earning 5% compound interest for 30 years, you can grow $10,000 to $43,000. But if you had simple interest on that $10,000, 30 years, you'd earn $10,000 into only $15,000. That's the difference of compound power, 15 or 43. Interest isn't just a modern concept. It's actually super old, it's ancient. The first recorded use of interest dates back like 5,000 years or so into Mesopotamia, where people were charging interest on loans of grain, and they were charging, I think they were using silver at the time. So like ancient Greece, ancient Rome, interest was being very normalized and very controversial, depending if they were charging compound. So philosophers that you've heard of, like Aristotle, believed that charging interest was actually unnatural. You shouldn't be making money just by money itself. In fact, in many early societies, interest, or what was known as usury, is what it used to be called, was condemned and straight up outright banned. Even in the Bible, it warned us against charging interest to the poor. But as commerce grew and banks emerged, interest became a cornerstone of economic systems. The real explosion, of course, came in about the 17th century with the rise of European banking, and especially when compound interest was formally adopted by the financial institutions. So by the 18th or 19th centuries, compound interest had gone from obscure, and maybe we shouldn't do it, to essential and very practical. It became the engine that powered pensions, it powers investments, and yes, it powers a massive amount of consumer debt. So let's apply what we've learned so far about simple and compound. Imagine you invest $10,000 at 5% simple interest. Each year, you'll earn $500. After 10 years, $5,000 total interest, your total net sum, $15,000. Not bad. But with compound interest, the same $10,000 earned interest on itself each year. So after 10 years at 5%, you've got $16,000. Keep it going for 30 years, you've got that $43,000 figure we talked about earlier. So there's an extra $28,000 between the two types of interest. And that's the magic of compounding interest. So what does that mean if you're on the wrong side of it? So let's say you're carrying a $10,000 credit card debt at a 20% annual percentage rate, and you're really only making minimum payments. That means the balance could take you literally 20 years to pay it off, and it will cost you double the original amount. Not 10,000, but 20,000. Compound interest doesn't care about your intentions, it's just math. So it rewards discipline and it punishes severely delay. So let's talk some real world examples. Simple interest loans are out there. They're not super common, but they're there. They're not always bad either. You'll see simple interest if you look at auto loans a lot of times, sometimes personal loans from credit unions or banks, and certain types of fixed rate mortgages. Think about here's clarity. So you know up front with simple interest what you're paying. The math is actually really easy to understand and do yourself. And often the total cost of borrowing is lower if you pay off early. The con a lot of times on simple interest notes, they front load the interest. And that means in the early parts of the months or the years, depending on how long your note is, most of your payment goes toward the interest and not principal. So it doesn't compound, but it still actually eats into your finances if you don't kind of pay it and play it strategically. Credit cards, on the other hand, are the financial landmine for those who do not understand interest, because credit cards typically use compound interest, and it's not annual compound interest either. It's often daily compounding. This means that every single day that you carry a balance, you're getting charged more interest on a slightly larger amount. So let's say your card has a 20% APR. It's pretty standard these days. That gets divided into a daily rate. So that could be, 0.054. It's got a lot of numbers. Just divide it by how many days in the month. It doesn't sound like that much, but the interest is compounding every day if you don't pay it in full. So here's the trick. If you pay your balance in full by the due date every month, you'll avoid all the interest. But if you carry a balance, even a few $100s, it grows into thousands over time. Credit cards are a prime example of compound interest being used against you. So let's flip this. How in the world do you get on the winning side of compound interest? First, you'll need financial tools that reward you for consistency. So I'll give you some common ones. Maybe something like a high yield savings account, great starting spot. Maybe dividend paying stocks or index funds, maybe real estate investments. But you could use one of my favorites, which is a properly structured whole life insurance policy, and using that policy for something called the infinite banking concept. Now, if you want more about how to use that policy for compound interest, you can actually just check out the link in the description of this video and you can find my full explanation on it. But let's continue for right now. Interest doesn't care whether you understand it or not. But if you do, you'll actually know the difference between simple and compound interest. You'll know how credit cards work. You'll know how to find better loans. And most importantly, you'll know how to start earning compound interest and put that time piece on your side. So what should you do after watching this video? Here's what I think. 1, start tracking your interest, what you're paying, what you're earning. Make sure you're not just working for your money, but your money is working for you. You've heard that before. And secondly, if you have not heard of the infinite banking concept, a way that you can personally have compound interest coming your direction, then you've got to start learning how to use whole life insurance to create your own compound growth engine. So like I mentioned, I've got links in the description of the video, but you could also book a free complimentary call with me and I'll walk you through it personally for you. I think compound interest is the bedrock to start building your financial fortress. Like Einstein once said, he who understands it earns it, and he who doesn't pays it. Peace.